Welcome back, Novello Nation, to another episode of the Aaron Novello podcast. I wanted to shoot you a quick video because something very important happened yesterday. We had our third 75 basis point rate hikes from the Federal Reserve. So we've never had two 75 basis point rate hikes back to back. This is like uncharted territory. Now we've had three. And if you understand the way the economic machine works, you can begin to prognosticate, the fancy word for like predict, right? With a high degree of probability. Again, nobody has a crystal ball. And I know it's very, very difficult to really get clarity, whether you're a consumer, meaning you're a buyer or a seller in the marketplace, or an agent, and you're trying to help buyers and sellers. My intention in, sharing this is in hopes that it can help you get clarity so you can make decisions that you feel are best for you and your family. The way the economic machine works is when there's too much money in a system, the only answer to remove that money from the system is restricts people's access to dollars, right? So inflation is when you have too many dollars chasing the same goods and services. So if there's too much money in the system, the only answer to that is to remove dollars from the system. And the way you do that is you restrict people's access to money. The government can't just go in and say, hey, banks, I want you to start charging more monies to consumers. At the same time, it does have a lever it can pull, and that's the Fed funds rate, right? And by raising the Fed funds rate, they're raising the overnight rate that banks borrow money from the Federal Reserve. And that has a trickle effect, right? It trickles down into all of the other forms of consumer debt. Right? Because if banks are being charged more money, they're going to pass that along to consumers and they'll charge them more money for access to the money. The Fed's funds rate does and is very much so correlated to the bond markets and the treasury markets. And the 10-year treasury note is at 3.54% and maybe even higher than that after I tape this. So we've already seen at the beginning of this year, we were at 3%, sometimes sub 3% interest rates for 30-year fixed mortgages. And we're now over 6.5% as of the time of me recording this. With rates continuing to go up, the Fed funds rate going up, the 10-year treasury going up, with a very high degree of probability, I would propose almost certainty that between now and the end of the year, we will see 7% mortgage rates, and if not, maybe 8%. And if not by the end of this year, that 8% number, certainly by the first quarter of 2023. So when that happens, as it pertains to residential real estate, everybody was really pounding their fist on the desk saying, there's no inventory, prices aren't going to come down. Well, the Federal Reserve realized that we had a problem on our hands. And the problem that we had on our hands is that they let very cheap money flood the market for too long, right? We went 2021, all of 2021 with very cheap money. And for those of us who were selling real estate in high volume, we could see that was creating a frenetic, frenzied market that was definitely not sustainable. I mean, we were seeing 30 offers on a property, like $10, $15, $20, $50,000 above asking price. Buyers removing financial contingencies, removing appraisal contingencies, removing inspection contingencies. All of that is not kind of a good financial decision to make. I remember talking to Carla, my wife, who we work with, and saying, this isn't feasible. Like, this isn't sustainable. And sure enough, the candle burns brightest before it goes out. So what I believe is happening is they realize that they can't really do anything about the inventory side of things, but they definitely can affect the supply side of things. By raising the Fed funds rate, they can dramatically increase the cost of money. And when you dramatically increase the cost of money, you shrink buyers' purchasing power, you shrink demand. And when you shrink demand, then you'll see a natural correction begin to take place. So I do believe with a high degree of probability moving forward, we'll see 10, 15, maybe even 20% price adjustments, which is a natural kind of, adjustment that needs to take place, right? Because we also have an affordability issue. So that's what we can expect. We can expect that we're going to be in a higher interest rate environment. We will be in an environment in which mortgage rates are much higher. As such, demand will be affected. And that's why we're already starting to see homes are sitting on the market longer. We're having to get price adjustments. We're not seeing as many offers come in. And we still haven't reached a point of capitulation in which homeowners recognize like, oh, this is a drastically different environment. Somebody who was approved in January of this year, let's say for, like $1 million, is now approved at current interest rates at like, 800. For those that are out there, let's say you're like a consumer and you're thinking like, oh, maybe I'm going to wait and maybe it'll get better by the end of the year. I wouldn't be waiting. If you have a life event, something that's really driving you to want to get your home on the market and get it sold sooner would definitely be better than later, in my professional opinion, having reviewed all this information in close detail. Also the pricing portion of the kind of decision about putting a home on the market becomes critically important. It becomes critically important that you have an agent that understands macroeconomics, market dynamics, and conditions and how they affect things. So that way they can provide you with appropriate guidance. 3 months from now, we could be in a completely different economic environment, right? We find ourselves with a few variables. One is interest rates, rising very quickly. Two is record high inflation. Three, we see the stock market retreating 6,000 points since the beginning of this year. And four, we are, in an economic war. We're not troops on the ground war, but an economic war over in the Ukraine. So if we look at all of those factors, like what's the probability that over the next 6 to 8 months that prices are going to go up exponentially, the economy is going to be booming, or that we'll see downward pressure moving forward? Like which one seems more probable? Well, the second one definitely seems more probable. So that's something to consider. And for agents, make sure that you really understand these things. It's unbelievable to me that sometimes I go into rooms with 100, 200, 300 agents and I ask them, what the Fed funds rate is, or how does that affect, the bond markets and the treasury markets and the mortgage markets. We have to be equipped with this information so that way we can equip those that we serve at the highest possible levels. So I hope this is helpful to you. That's my intention. If you have liked this episode, be sure to smash the subscribe button, share it with anybody that you think it would be helpful or useful to. We appreciate, the advocacy for sure. And I look forward to reconnecting with you soon.